International Monetary Fund Managing Director Kristalina Georgieva made the following statement today at the third meeting of G20 finance ministers and central bank governors in Gandhinagar, India. I would like to thank the government of India for its generous hospitality, and Finance Minister Nirmala Sitharaman and Governor Shaktikanta Das for their exceptional leadership of the G20. I have said before that India is a bright spot in the global economy, and India's dynamism was clearly evident during our meetings. Outlook: the global economy has shown some resilience. Despite successive shocks in recent years and soaring interest rates, global economic growth, although sluggish by historical standards, remains firmly in positive territory, supported by strong labor markets and robust demand for services. That said, activity is slowing, particularly in the manufacturing sector. Looking ahead, medium-term growth prospects remain weak. Moreover, the divergence in economic conditions across countries is a continuing concern. Some sectors of the global economy are thriving, others are weakening but still growing, and vulnerable countries are falling further behind. As for inflation, there is some encouraging news: the trend is finally coming down. But overall inflation is still too high, and core inflation remains volatile despite significant monetary tightening. Higher food and fertilizer prices are particularly worrisome, especially for low-income households, for whom food insecurity and malnutrition are now much more persistent. Thus, we see a mixed picture and risks remain. Downside risks: inflation could remain higher for longer, requiring even more monetary tightening, and fragmentation could put even more pressure on economic growth. To mitigate these risks, I urge G20 leaders to seize the opportunity to put the global economy on a more dynamic medium-term path. This requires both domestic and international policy action. Domestic policy priorities: the top priority is to reduce inflation over the long term. Despite progress, the job is not yet done. Monetary policy must remain the same. Premature celebration could reverse the hard-won gains made so far in disinflation. Rather, if we stay the course, we can enjoy price stability as the basis for growth and prosperity. It is time to rebuild fiscal reserves after a period of exceptional policy easing. We would like to see fiscal policy consolidation to improve debt sustainability and support lower inflation, while ensuring adequate protection for the most vulnerable. Growth-enhancing reforms are needed to increase productivity and raise living standards. Digitalization holds great promise if we learn from proven successes, such as India's success in public digital infrastructure, as a foundation for dynamism and growth. To support these reform efforts, the fund will also expand its work to mobilize domestic resources, improve the quality of countries' spending, create deep capital markets, and improve the environment for private investment, both domestic and foreign. Strengthening the international financial architecture: the international financial architecture has served the world well. Since World War II, the world economy has grown more than tenfold in real terms. This has led to huge improvements in human well-being. For example, life expectancy in 1950 was only about 45 years worldwide. But if the international financial architecture is to continue to deliver, we must recognize that today's world is more shock-prone and fragile, with climate change, pandemics, and Russia's invasion of Ukraine causing widespread unrest. Resilience to shocks is unevenly distributed. Some countries are in a better position to protect their populations than others. What are the priorities for G20 countries? To protect the most vulnerable countries and their populations, we need to strengthen the global financial safety net. While developed and strong emerging market economies have a cushion of more than $10 trillion in international reserves, the rest of the world relies on the pooled resources of international institutions such as the IMF. Today, while the IMF has a lending capacity of nearly $1 trillion, quota resources, which are critical to the predictability of the IMF's firepower, have shrunk in relative terms. I call on the G20 countries to restore IMF quota resources primacy by successfully completing the 16th quota review by the end of this year. As our support to low-income countries has quadrupled in recent years and demand remains high, the IMF urgently needs to replenish subsidy resources in the Poverty Reduction and Growth Facility, PRGT. I call on the G20 to close the PRGT's subsidy gap and put it on a sustainable footing for the future, including by exploring options for using the IMF's domestic resources. The IMF's newest instrument, the Resilient Sustainability Trust, RST, is financed by providing SDRs on lending, a remarkable innovation that turns a sleeping asset of strong countries into firepower to support vulnerable countries. The G20 achieved its goal of allocating $100 billion to channel SDRs to vulnerable countries. For the IMF, this mobilized $45 billion for the PRGT and $42 billion for FIRST. Let's work together to strengthen the firepower of FIRST. On restoring debt sustainability, we have made welcome progress. The recent agreement to restructure Zambia's debt was an important milestone for the overall G20 framework, building on earlier steps to address Chad's debt. The Global Sovereign Debt Roundtable, GSDR, co-chaired by the G20 Indian Presidency, the IMF, and the World Bank, has fostered a common understanding of key issues, including comparability of approach and information sharing. While this progress is important and welcome, the debt restructuring process still needs to be faster and more efficient. The costs of delays in reaching agreement on the necessary debt resolution procedures fall acutely on borrowing countries and their populations, which are least able to bear the burden. The GSDR is the appropriate forum for making more progress, including clear timeframes, suspension of debt service during negotiations, and improved creditor coordination on debt workouts for countries outside the general framework. And so we have a lot of work to do. Our world may be richer today than when the current international financial architecture was established, but it is also more fragile. The world economy has shown resilience, but that resilience is unevenly distributed. With domestic policies to improve long-term growth prospects and international action to support the most vulnerable members of our global community, we can achieve a brighter and more inclusive future.